Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is November 16th, 2023, and today we're going to discuss bonds and oil signaling economic threats. To start with, we're going to look at crude. Now, crude has made lower highs, lower lows after an amazing run up from June. Obviously, the big drive higher, which is normal to start in May, as we see the driving or travel season kick off and we see the higher highs, higher lows. But we then created lower highs and lower lows. We broke out and reversed the trend. The lower highs, lower lows created what arguably could be looking a funny head and shoulders pattern. But today was significant. Today was a significant breakout because we broke through and erased all the trading all the way back into July. So the bullish move from 71, well, I'll call it 72, up to 93 has now been erased. We've traveled all the way back down to inside the previous year's resistance level, ignoring this breakout through here. Crude is a big indication of not just demand from consumers wanting to drive their cars like we look for in the summer months, but crude is also an indication of consumer spending. Crude can be an indication of consumer spending because we have to transport all the goods all over the country. We have to transport them around the world. It also is an indication of business purchases and what we can expect with the airlines. And so crude selling off really aggressively is a combination of multiple things, but I would treat this as an indication of lack of demand. And if we look at crude and see this lower breakdown and pushing back into these lower levels, this is the next break point, right about 71.50. You can see there's a support level in December of last year, January and February. We can see that there's resistance in May and June before we broke out and began the uptrend. So if we clear that 71.50, there's nothing holding crude up from showing there's no demand pushing back down to these lows. Now we'll go to bonds in a minute, but let's go to copper first as my indicator for demand in the manufacturing sector. Clearly we've been in a downtrend, pulled back a little bit and went right back into the downtrend in the short term. All we've done is retested the horizontal high. We could be setting up for an uptrend off of these higher lows, but to me, we're just in a holding pattern after selling off at the highs, and we are testing in near the annual lows. It's not just the annual lows, though. If we look all the way back to 2020, we had a huge amount of demand for copper as manufacturers tried to close the gap between supply and demand. We had supply chain issues, as everyone was talking about. And we see that 2020 saw this shoot all the way up from about $1.97, call it $2 even, all the way up to $5. So huge amounts of demand, huge amounts of growth in copper. But from this point, we've pulled back from $5 and we're sitting about $3.69. That is to say, from the highs, we pulled back almost 40%, right there. And then we returned up and dropped again, and we're sitting at about 25% down. Well, it's 26, 27% down. So we're still 25% off the high. In any other market, this would be considered a bear market. Even if we include this rally in the last year, from the peak to the pullback, you can see we're about 15% down. So we're seeing crude in a bear market. We're seeing copper in a bear market. These two components, copper and crude, account for the majority of all aspects of consumer demand. Whether we're talking again about flights and travel, whether we're talking about transportation of goods in trucking all across the world, we're talking about manufacturing, as copper is the most used metal in all of electronics. This is a big indication of what I would consider destruction of demand. Before we go to bonds, one more thing. Let's talk Walmart. Walmart beat earnings expectations by half a penny, if you look at this right down through here, but they warned that they expected the retail season, the holiday season, the purchasing season that occurs in this last quarter to show considerable signs of slowdown, slower demand. We're seeing the destruction of demand across the board. And they expect this retail season to be a major miss. Now we can take a look at the articles like on Forbes. You can see right through here, Forbes has expected the profits this year to come in below analyst expectations, and their stock dropped 8% as the retail warned so that consumers still tightening their belt. We're not done reducing our purchases. We're not done getting more thrifty or safe into this final quarter. So Walmart being one of the largest retailers in the world, right there with Amazon, is saying that we're going to miss. Now, it's something good to note. Walmart is just one representation of retail. But retail sales, nearly 80% of all retail sales happen in the final quarter. So all the other stuff that's happened this year earlier, the other 3 quarters are about 20%. So if 80% happens in the final quarter of the year, and we're expecting them to be less than analysts expect, it is no wonder that we saw this massive gap down. If we jump over to TJ Maxx or TJX companies, you can see they gap down on their earnings before Walmart. Maybe giving us an early clue there as well. You can look at their earnings and you say, how did they do? What did their report show? And you can see it right here, there we go, that they beat expectations as well. It's not the expectation beat, it's the future expectations that we're already pricing in a discount store like TJX. Even Kroger responded to it. Even though Kroger, is oftentimes considered grocery, Kroger is Fred Meyer, Smith's, Harris Teeter, Kroger stores, I think Fry's as well. But as we're looking at this, we're pricing that in as well because their superstores and their marketplaces have a tendency to sell a lot during the holiday season as well. And you can see that not based off earnings, but based off Walmart's comment, that we also saw almost a 5% drop in Kroger. If we only expected a slight slowdown in retail for the holiday season, like Walmart down a little bit, maybe a little less purchasing going into the holiday season, Kroger dipping, TJ Maxx dipping, some of the discount dipping only, but not in other areas, then we might be fine and we wouldn't be worried too much about it. But if we see that worry spills into defensive plays, a flight to safety, then we would expect to see utilities do well, healthcare do well, consumer staples do well. And consumer staples didn't do well today, but utilities were the number one performing sector. That's partly due because oil prices are falling and therefore it makes it cheaper to produce utilities. But as we watch the move to the defensive sectors, we would also look to see where else would we see as defensive. Is inflation over? No. So we'd expect gold to go higher. And if we're afraid but looking for a return, we would also run over to bonds. So as oil prices fall, bonds go higher, and we see that bonds perform at 0.64%, and gold was up nearly 1% today as well. So as bonds push through these highs, closing at the highest level that we've closed at, going all the way back to September 20th, completing what I would argue is an inverse head and shoulders, this is not pricing in rate hikes. That's maybe a good thing, but it's also showing a flight to safety and an end of this downtrend. We have now created a full set of higher highs, higher lows after this massive downtrend. And if we're seeking that return that is safe, bonds have a tendency to rise. Now we could be pricing in rate cuts. And if we're pricing in rate cuts, that's also telling us, or also confirming the idea that we're headed into a recession or a slowdown. And that's a problem as well. In fact, as a side note, the previous or former Walmart CEO, Bill Simon, also said this is the first time in over a decade that we have seen consumers really starting to break, to buckle, as he calls it. And not only saying that they are buckling for the first time in over a decade, but it's the first time in a very long time there's been a reason for the consumer to pause. Now, this is coming from someone that benefits from the idea that we should keep buying and buying and buying and buying. Additionally, he commented the fact that not only are we seeing that inflation is still in play, you're going to see all your ads this holiday season not say, hey, the 50-inch TV is at $199. You're going to see that the 50-inch TV is 40% off. And he said, this is a direct quote, "You use percentages when you're not real proud of your price point. I think you've got inflation pushing the relative price points up." So what he's saying is, if we were really proud about what we're charging, if we thought this was a screaming deal, if we thought $199 was a good price for a TV, great, we will tell you $199 for this TV. But what he's saying is we can't charge $199. We're not real proud of the price. And so if it's a $500 TV, we're going to tell you that we're selling it at a 40% discount. So it's a $300 TV. They don't feel good or don't think that it's very attractive to say it's a $300 TV. So instead they say you're saving 40%. And he said that's a clue to tell you that we're not proud of the price point and that inflation is still such an issue that it's going to hurt or harm the sales. It's a relative pricing rather than actual price. And the inflation is still there and impacting the consumers, and the consumers are finally, their knees are buckling. Now that's me taking his buckle comment and taking it to the next step. I think there's just too much weight on the consumer. So if we take a look at consumer discretionary, we've done this before. We're going to take XLY. XLY includes Tesla. If we take XLY and take out Tesla, and we're currently at a 5-to-3 ratio to get it to where I want it to be, where we're above the zero the whole time, we're looking at this to potentially fall back, and consumer discretionary is near its peak, near its resistance, and if we see consumer discretionary fall back down, we could see a drop of nearly, well, on this ratio, 50 times. And we can see it go from 129 back to parity. And so major losses are setting up for consumer discretionary. If we take a look at Nike, Nike is the one that mirrors this pretty closely as far as the charting goes. And the question is, are we going to see it sell from 107? And if we fall from 107 to 97 or 107 all the way back down to 87, then a move from the current price down to the low is nearly a 20% drop off of this high. And if we look at the beginning of this year, where we had the peak in Nike, we've already dropped 32% and sitting currently down 20. So we could see another 20% drop from the current price and push past 40% if we return back to the lows. So where's the defensive places? Well, one, bonds. You can certainly take a look and say TLT is breaking out, just like we saw ZN break out. TLT, IEF. This would be a situation where we start rolling into longer term fixed income as we've cleared the highs and broke out through here. But we can also go into those defensive sectors. We can say, let's take a look at XLU. Is XLU looking very much like bond? Yes. We've rallied, created higher highs, higher lows. We've tested this level, and if we're going to see utilities continue to climb, we could buy XLU or maybe simply buy something like Southern. Southern has already pushed to higher highs, higher lows. We still have some upside. If we continue this pattern, this trend, we could be looking at prices drifting up to 76, 78, if not even higher. So we could be looking at 10% move higher in a company like Southern versus 8, 10, 20% lower in Nike and consumer discretionary. We could take a look at healthcare, XLV. Healthcare is usually a defensive sector, similarly sitting at short-term resistance, trying to create higher highs and higher lows. And we could look at the companies inside of there, like Johnson & Johnson and Abbott Labs. If we take a look at Abbott Labs today, Abbott Labs broke through all the resistance levels, going all the way back to the same September 20th, clearing everything out, making higher highs, higher lows, confirming a price pattern like I discussed today in the main room. And we're talking about a price pattern that now could duplicate this, we'll call it this ascending triangle or wedge, whatever you want to call it. And that puts me on track for a 107 target for something like Abbott Labs, which is another 8 to 10% move. So there are stocks, there are companies, there are sectors and areas that are still going to be bullish as a defensive play. I'm not looking for 10, 20, 30, 40% immediately, but I'm looking at 10% over the next 3 to 6 months. And that could be the defensive play if we're seeing the first warning signs, the first cracks, the warnings that oil's issued, the warnings that bonds have issued, the warnings that have been directly issued by Walmart. Now, I'm not saying that we should be looking to short technology yet, because I think technology is going to still try to push up to these highs because we want to see the best performing stuff. So we're chasing performance, really. So we're chasing performance or an outcome, a return, and it's either we want the return based off safety, like a bond, 5, 6%, or we want the risk-adjusted growth that is in the tech sector. So I'm not done with the tech sector or the Nasdaq or XLK or XLC pushing higher, but I am telling you to watch these because they're getting near the top. And whether we can make a new high before the end of the year after we put in the high today, that's a big question mark for me, because I do think the market's going to start adjusting into safety. Money is leaving the United States looking for safety. That is also another indication that we are probably seeing a slowdown in the U.S. economy. The problem there as well is if the U.S. economy is sick, the world is sick. We are the consumers of the world, and that's going to feed into probably a global recession. And not to do doom and gloom, but we definitely got a warning both from Walmart and from the futures markets and bonds and oil. All right, well, that's going to do it for me today. Have a great day. We're going to talk to you again next week.